I know many investors are concerned about inflation. It has risen to levels that many parts of the developed world haven't seen for 40 years, exceeding 8% in the U.S. last month alone. In the U.S., the Fed is trying to break inflation by slowing the economy, increasing rates, reducing liquidity, and increasing the cost of borrowing. Of course, monetary policy is a blunt instrument, and there is not an insignificant chance that the U.S. economy dips into a recession in the next year. Rising rates have caused the bond and stock market to reprice dramatically over the past few weeks. And the increasing chance of a recession undermined equities further. As you've seen in your own portfolios, when rates go up quickly, equity and bond prices tend to go down together. Now, the news cycle is full of claims that 60-40, traditional diversification, is dead. Hardly. It is time-tested since the late 1920s. It has seen high inflation, low inflation, bull markets and bear markets, market and business cycles of different shapes and sizes. So here's what we know. First, a diversified portfolio gives investors the best odds of increasing purchasing power over the long term, even in a high inflation world. Time and time again, equities have proven a strong diversifier. Second, we've seen some investors tilt towards commodities, REITs, and tips. These types of hedges can help for unexpected jumps in inflation. But an investor must hold them ahead of time. And over the long run, some hedges, like commodities, can raise volatility in your portfolio to intolerable levels. Third, you'll be glad to have bonds in your portfolio if we do enter a recession. And finally, remember, rising rates aren't all bad for bond investors. You'll be reinvesting at an even higher yield. As markets go down, avoid the trap of doing something. Locking in losses usually means missing out on the ensuing gains too. Stay focused on your goals, maintain your disciplined approach, and enjoy the long-term benefits of a diversified portfolio.